Hey there, and welcome to my channel, The Paper Bag Investor. Today I want to look at the company Very Good Foods. Ask the question, is the market cap too large? Is it justifiable after its recent stock surge? So let's get into it. So I recently did a video on the Very Good Food Company, and after doing my research and creating that video, I had actually an amount of money in mind to invest in the company. And the day I released that video, the stock actually started surging. I bought a portion of my shares that day before, but not the entire amount that I planned to invest, only about a quarter of what I planned. So you might be in a position like I am, or you're looking at this company and you're saying to yourself, well, now it's just surged actually about 50% in the days after that video and after I bought my first shares of it. Should I buy more? Is it still a buy, or is the market cap too high? If you haven't seen that original video that I did on the Very Good Food Company, I will link it down below in the description. I think it's a good one to watch. I actually did a taste test of their products and then looked kind of at a number of things I liked about the company. So in this video, I wanted to try and do some kind of quick analysis to see, is this price justifiable? From some of their investor relations communications, I've seen that they get an average of $16 a pound in revenue from their product sales. And out of their main facility in Victoria, they currently it seems they're doing about 11,000 pounds per week, and they've grown that significantly to 11,000 pounds a week, and they plan to further increase that to approximately 19,000 pounds a week out of that facility. And then they're also building a facility in Vancouver, and then also have the lease on a facility in California. So if you didn't get the picture, they're a very high-growth company. So a company like this, high-growth company, you kind of have to look out into the future, maybe 2 years into the future, and guess what could their sales be, what could their expenses be, what could their net income be at that time, and do they still have future growth ahead of them or not? And then from there, that kind of 2 years out horizon, try and create a valuation for the company today, and then compare that to what the company is actually valued at by the market, and that gives you an idea, is it really worth buying still or not? Is it overpriced, underpriced, or is it priced just right with the market? So as I mentioned, if say they can get up to 19,000 pounds a week out of Victoria, and then let's say 2 years from now, along with Victoria, their Vancouver's running, and they've taken all they learned from Victoria plant and implemented it there in Vancouver, and along with that also California's. So you maybe have 3 facilities, each producing 19,000 pounds a week. So 19,000 pounds a week times by 3 gives 57,000 pounds per week. Then if you multiply that by $16 a pound, you get about $912,000 a week. They multiply that again by 52 weeks in a year, you'd have $47 million a year in potential revenue. Just for simplicity's sake, we're going to call that maybe $45 million in sales by 2022. And based on how much demand and backlog there is for their product, it seems they would have no problem selling that amount of product in a year. If they were able to produce it, that is, of course. And now they've averaged about 35 to 45% gross margin on their products over the last year or so. So let's say we're going to take a 40% gross margin on those sales. And so you go take 40% of 45 million in sales, that gives $18 million in gross profit for the year 2022. Now, to get an operating profit, we still have to subtract their operating expenses. So I looked up their financials that were released from January to June of 2020, and their operating expenses during that 6-month time period was $3.2 million. And because they're a fast-growing company, their operating expenses have been growing year over year as their sales have been rapidly growing. But say going forward as they may build these 2 more facilities and they get those operating, let's just try and take a stab at what their operating expenses could be. So say their revenues go from sort of $5 million a year, their kind of current run rate they're at right now, to $45 million a year. In 2 years from now, it'd be a 9x increase, which is kind of feasible actually, because like I said, the last year I know they did about a 3 or 4x increase. So you do 3x increase again, million, and then 3x increase again as you speed up and bring online these other 2 facilities or 3 facilities. You could have that 45 million in sales, a 9x increase. But how much would their operating expenses be? So let's say they had 3.2 million for 2020, and say we'll just double that to make a yearly and annual rate of 6.4 million in operating expenses. And let's just assume their operating expenses double in that same 2 years. So maybe that go up to $12.8 million operating expenses for the year in 2022, roughly. Of course, when you're trying to extrapolate on an exponential curve, even 6 months a year can make a huge difference. But this is one way to take a stab at it. So we had 18 million in gross profit, and we had 12.8 million in operating expenses. So if we subtract those 2 numbers, we end up with an operating profit of $5.2 million. Now the real question is, what kind of multiple price to earnings multiple would the market maybe apply to a company like this in 2022? I think it would be a very generous multiple. We can't know for certain, but if you look at a company like Beyond Meat, that's currently not GAAP profitable, but has a market cap around $9 to $10 billion. So there's a lot of optimism, obviously, in the marketplace for these kind of plant-based meat alternative companies. And if Very Good Foods, their sales in 2 years are, say, at 45 million, I could see the market easily giving them a PE ratio of 40, maybe even 50. So let's say if they give it a PE of 40 and we said their operating income was around 5 million, then that gives you a market cap of about $200 million. And that's almost exactly what the price is right now for Very Good Foods. It's about $200 million market cap, or just under right now at the time I'm recording this. And with our assumptions and our estimates, and then with a PE of 40, you'd get basically that number. Meaning it's kind of correctly valued for that kind of risk assumptions you're taking into account there. Of course, you might say, well, they have the sky's the limit. They could be selling, someday they could sell $500 million of sales, 10 times the sales. In that case, you could argue that a PE of 50, 60, 70, from what sort of 2 years out sales could even be argued, because the company would grow into that multiple. In that sort of case or scenario, then obviously you could argue that is still undervalued even at $200 million. And I think for me, and the question we're asking as investors and I asked for this video is it still a good buy after this huge run up? Well, based on these kind of limited assumptions and this napkin math we've done, we could say it's not, you could argue it's not overvalued, but it might be rightly valued, maybe possibly undervalued, depending on how you calculate it. But for me, I think there's 2 key questions that I need to drill down further into before I would really invest heavily in a company like this. What are those 2 questions? Number 1 is the products. What do people think about the products? I tried a couple of the products myself, and I've seen some reviews and seen some information about it, and know they're very positive feedback, comments, reviews on the products, but I haven't done enough research in that for myself to be happy. So I'm going to drill down deeper into that and really just read reviews, find reviews, see video reviews of other people trying different products that they offer. Essentially just finding any bit of information I can, what people really think about their products. Okay, then the second question I have is, what about the leadership? So their CEO, Mitchell Scott, who's one of the co-founder of the company. I really love that. As I mentioned in my other Very Good Foods video, I love that he's a co-founder. And he's, of course, heavily invested in the company. But I guess the question I have is, what's his story? What does he bring to the table as the leader of the company? When you ask him a difficult question, how articulate and how clear is he in his response to, say, a difficult question? So I can find on him and listen to those interviews, bring up anything he's written online, in a sense, try and get a sense of who he is, his background, what he's done, how he thinks about things, how clearly and easily can he articulate the solution to a problem in a way that makes sense, and ultimately, what's his character like as a business leader? So those are the two questions I really want to drill down into. What are their products like, and what's their key leader like, their leadership and their leadership team, but especially their CEO, Mitchell Scott. So I'm going to drill down further into those questions, but thank you guys so much for watching this video. If you enjoy this video, I encourage you hit that subscribe button down below. I'm going to be making lots more content like this for you guys about high growth companies that I see could be potentially big winners, and the ones I really see are going to be big winners, aka Tesla and others I'll be finding, and I'll be sharing these insights with you guys. So definitely encourage you, hit that subscribe button. While you're at it, hit that thumbs up, helps me out a lot. Okay, appreciate you all. Thank you so much for watching. Thank you for your time, taking your time to watch this. Have a great day. Bye.